How you invest in retirement should look different from how you invest before retirement. So let me show you an example to make this a little bit more clear. So what I've done here is I've put together three different portfolios. And portfolio A is going to be 100% stocks. Portfolio B is going to be a 60-40 portfolio. And then portfolio C is going to be 100% stocks. So what I wanted to do is show what would happen to this retirement portfolio given these three different examples during an entire decade. And what I've done is I've shown this during what I consider to be the worst timing in history to retire, or recent history to retire. And that's going to be in January 2000. Because what happened in January 2000 was the implosion of the tech bubble. There was the internet boom, and the markets rallied heavily, including the NASDAQ portfolio in the 1990s. It peaked in early 2000, and then we had what was called the lost decade. So I feel like this is a really great example to highlight, just given the risks of holding a 100% stock portfolio. So as you can see, we started with $1 million in each, and I'm going to go back to these metrics here in a bit. I'm going to scroll down and show you what the end result is. So this bottom blue line is going to be your 100% stock portfolio starting in January of 2020. And by the end of the decade, so December 31st, 2009, you're left with less than $500,000, given this $40,000 withdrawal rate. This is inflation adjusted. I try to make this as realistic as possible. And these are pulling in real returns, the real returns for the stock market, the US stock market, and the real returns for the US bond market. And it just goes to show what happens to your portfolio if you're experiencing a sequence of returns that are not attractive at all. If we look at this portfolio year by year, you can see exactly why this portfolio A, this 100% stock portfolio, did not perform well. That's because in year one, the portfolio was down 11%. In year two, down 11%. In year three, down 21%. So if you combine that with these withdrawal rates, so 41,000, 42, 43,000, all these are inflation adjusted, of course, that combined with just a negative portfolio, you're never actually able to recover from that devastating effect. Of course, stocks tend to go up over time. They don't tend to go sideways or down. Volatility is the price that you're paying for that return in equities. But sometimes that volatility does not work in your favor. Now, I know that this is a pretty dramatic example here, but I think it's very important. Over time, like I said, stocks do go up, but in the short term, they don't. On a daily basis, you can expect stocks to go up by 52% and down by 48%. On a monthly basis, you should expect stocks to go up by 67% and down by 33%. On an annual basis, 75% up, 25% down. But on a 10-year basis, you should expect it to go up 95% of the time, but down by 5%. So that 5% is exactly what I'm highlighting here. During the lost decade, which is January 2000 all the way through December 31st, 2009, that 10-year span, the S&P 500 was flat, technically slightly negative. And so the reason why is because you had two different catastrophes during that time frame. The first one is the one that I highlighted right here. You had the tech bubble imploding. You had 3 years of negative returns. So if you were to retire in that time frame, it was pretty devastating. And then you had the 2008 great financial crisis, 37%, pretty devastating as well. That was not a great time to be invested in the stock market. It was a great time to begin investing, but not great for those who are actually retired and withdrawing from their portfolio. So the point of all this is because I wanted to highlight what would happen if you tempered this 100% stock portfolio with some bonds. So this green line here is going to be a 60-40 portfolio. So bonds did pretty well. So the top line is the 100% bond portfolio. The bond portfolio did pretty well in this scenario. So technically speaking, you would have been better off just buying a 100% bond portfolio for that decade. Not advocating for that at all. But during this time frame, it did outperform. So if you were to take some of that asset class and temper it, then you would be much better off than just being in a 100% stock portfolio. Okay, so if we were to take this time frame from 2000, 2010, and we were to extend it out, what would happen with these three different portfolios? I think this really does drive this point home. So again, the blue line is going to be your 100% stock portfolio. Again, everybody knows stocks go up over time, and especially US stocks, it's an asset class that's really difficult to outperform over a period of not only 10 years, but here, 25 years. But because you're withdrawing from this portfolio, again, $40,000 inflation adjusted every single year, this portfolio never fully recovers. And after a period of 25 years, you're not even back to where you started. Your $1 million portfolio is only worth $761,000, whereas your 100% bond portfolio is slightly outperformed at 761,000, but your 60/40 portfolio is $1.3 million. So the 60/40 portfolio in this scenario does outperform. So in retirement, a balanced portfolio will beat a heavy weighted stock portfolio simply because that risk is just far too high. So you want stock exposure for that growth, but there is a real risk of outliving your portfolio. So giving your portfolio growth exposure does make a lot of sense, but you don't want too much exposure for the reasons that we just talked about. So the smart approach is to temper that portfolio with bonds. And one approach that I like is to start with a 60/40 portfolio in retirement and to trim that equity exposure by 1% per year as you age. It's a straightforward glide path that steadily lowers your risk while you spend your portfolio down. Of course, your own unique situation needs to be considered, especially as you map out your own withdrawal strategy and tax situation. If you're ready to build an investment strategy that fits your retirement goals, reach out to us at bullock.com. We're happy to walk you through how we'd structure this for you and explore whether it's a good fit. Thanks for watching. Hit that subscribe button so you don't miss our next video on retirement planning.